Hello, I'm Robert and welcome to my channel where I talk about everything automated algorithmic trading or simply algo trading. Today, finally, is the day that we wrap up the 20 pip challenge. We have taken a total of 106 trades. This little test started 8/24/2023, and in roughly a 32-day period, it completed the test. It did exceptionally well for the market conditions that we are in. As we can see from this information, this was our starting balance. So let's get to the bottom of this and really look at where we are at the moment. Here we are, an ending balance of 98.66. We lost $1.50. That may not seem impressive, but when you really look at the market conditions we are in, for example, Euro USD has been in a 10-week bearish trend. The first time in the history of this asset being tracked for the last 17 consecutive years. This is the first time this market has maintained a 10-week bearish cycle. So the fact that we only lost roughly $1.50 in that time is actually very good. Now that's not to say that this technique can't be improved, because it can. Every technique can be improved. There's always room for improvement. But it did one of the most critical and most important things necessary in any strategy. It protected the balance exceptionally well, considering how bad the current market is. So it's not a failure, but really it is a success. It's not a profitable success, but it is a success. Remember, profitability and success are not the same thing. You could be 100% successful and still lose money. That is important to remember when you're going through this test, through this analysis, through this process. Now let's talk about some of the more nuanced or less obvious factors about this painstaking process. That really is the point of what algorithmic trading is. Painstaking, meticulous. It is a process that goes through a series of steps, one after the other, to determine a genuine, viable, finished strategy. If you're sitting on the edge of your seat, worrying about your budget, if you're laying awake at night, hoping that your trade goes in the right direction, you've over-leveraged yourself and you've taken on too much risk. The goal of these strategies, the goal of algorithmic trading in general, is this right here. Not having to worry about what is going to happen. No matter which way the market is going, you know through the process, through the methodology, through the steps of doing this type of an analysis, that by the time you get to using your real money, you have a reasonable level of protection built in. You've gone through, you've made decisions, you've made changes, you've made corrections, you've studied the market, you've done your research, and you have now, at this point, a process by which you can refine more and repeat the test, or move to a live market if you're satisfied with the results of the test. In this particular case, this strategy would have done exceptionally well had this had been a bullish market. Meaning, had the market moved in the direction of my trades more often than not, you would have made a profit, and a very generous profit. The fact that this really held its own so well against such a market is a testament to the resiliency of the strategy itself. But, yes, the dreaded but. The one thing that's missing from this strategy that really should be in place is you should have some kind of a hedging trade process going on. This was Euro Canadian. So whether it's a separate account running the opposite of what this account is running, or whether it's trading an inversely correlated pair, you should have some kind of a hedge going on. A stop loss by itself should not be your only way to mitigate risk. We can see that by itself it did a good job, but it should not be your only way. Never put all your eggs in one basket. Never just focus on one particular approach. You need to be careful not to overextend yourself and have too many irons in the fire, but you should always have at least one hedge for your trading. That means you should always trade two pairs, and either trade in the opposite direction if it's the same pair on two different accounts, or in the same direction if the pairs are inversely correlated. Or if the pairs are directly correlated, such as Euro USD, Australian USD, meaning they both go up at the same time, they both go down at the same time, then you long one, short the other, so that you have opposition trading going on at all times. So as we move forward, the lessons to take from this process, from this methodology, is that trading is just that, a process, a methodology, a science. There is nothing about this that is gambling, unless you yourself make it that way through reckless maneuvers. If you use a computer to help you trade, and you use this kind of methodology, you will stand a better chance to profit in the real market. You will have the process able to literally be able to withstand any market condition. And now let's actually go look at a process that shows that in real time through the logs of something that is using the same three moving averages I've used here, but it shows a more successful delivery. Okay, here we go, looking at the Australian US dollar. And you can see a profit system that uses the 20 pip thinking process, but I'm using a different stop loss. I'm actually using a stop loss based upon the market average. And I'm running tests only, which is why the size is so small. And you can see that all of these were in profit. So let's take a look at the second pair.